Hello everyone, and welcome back to the channel. As 2025 draws to a close, it's time for our deep dive into the Canadian economy. We're breaking down the latest numbers on GDP, inflation, housing, and the job market to give you a clear picture of where we stand and what might be coming in. 2026. This year has been a real mixed bag, with some bright spots, but also some clear signs of a slowdown. Let's get right into it. First up, let's talk about gross domestic product, or GDP, which is the broadest measure of our economic health. The latest data for October 2025 wasn't great. Real GDP actually shrank by 0.3%. Now, that might not sound like a huge number, but it's the steepest monthly drop we've seen since late 2022, and it completely wiped out the small gain we saw in September. So, what caused this dip? It was a pretty widespread decline. The goods-producing side of the economy fell by 0.7%. Manufacturing took a big hit, dropping 1.5%. We also saw a contraction in oil and gas extraction, partly due to some planned facility maintenance. But it wasn't just about goods. The services sector also declined by 0.2%. A big reason for this was labor disputes. The Canada Post strike and the Alberta teachers' strike both had a noticeable impact on the numbers, slowing down economic activity. Now, it's not all doom and gloom. Statistics Canada has given us an early peek at the November numbers, and it looks like we might see a small rebound of about 0.1%. This little boost is expected to come from sectors like construction, transportation, and education getting back on track. However, when we zoom out and look at the final quarter of 2025 as a whole, the picture is still quite sluggish. Most economists are forecasting that growth for the fourth quarter will be either flat or even slightly negative. Some banks are estimating an annualized decline of 0.5%. Tease means we're heading into 2026 with very little economic momentum, which is definitely a cause for concern. All right, let's switch gears and talk about something we all feel in our daily lives. Inflation. The headline inflation rate for November held steady at 2.2%, the same as it was in October. This is pretty close to the Bank of Canada's target, which is good news on the surface. But, as always, the devil is in the details. The big story here is food prices. After a period of cooling down, grocery price inflation shot back up to 4.7% year over year. That's the fastest pace we've seen in almost 2 years. If you felt your grocery bill getting heavier, you weren't imagining it. We saw significant price jumps for things like fresh fruit and beef. And get this, the price of coffee surged by nearly 28%, mainly due to supply chain issues. That morning cup is getting a lot more expensive. On the flip side, what's helping to keep the overall inflation rate down? Gasoline prices, they fell by 7.8% compared to last year, acting as a major drag on the headline number. Without this drop in gas prices, our overall inflation rate would look quite a bit higher. Shelter costs are another key piece of the puzzle. Rent inflation, which has been a huge pressure point for many Canadians, actually eased a little bit in November, coming in at 4.7%. That's a welcome bit of relief, though still very high. The Bank of Canada also looks at core inflation measures, which strip out volatile items like food and gas. These core measures have generally remained stable or eased slightly, hovering in the range of 2.5 to 3.0%. This suggests that the underlying inflationary pressures in the economy are beginning to moderate, which is exactly what the central bank wants to see. Now, let's move on to the housing market, a topic that's always on everyone's mind. The market has been in a strange state for most of the year, almost like a standoff between buyers and sellers. In October, investment in new home construction actually fell by 0.8%. This was mostly driven by a drop in the construction of single-family homes, especially in Ontario and Alberta. High borrowing costs and economic uncertainty have made both builders and buyers more cautious. In major markets like Toronto and Vancouver, we're seeing a lot of inventory sitting on the market, but buyers are hesitant to pull the trigger. This has led to prices stagnating or even drifting down slightly. It seems many potential buyers are just waiting on the sidelines, hoping for either lower prices or lower interest rates. However, the story isn't the same across the entire country. We're seeing a real regional divergence. Markets in the prairies, like Calgary and Regina, and also Quebec City, are much tighter. In these cities, there's less inventory available relative to the number of people looking to buy, and as a result, prices are still showing some growth. So what's the outlook for 2026? The high interest rate environment has really cooled things down. But with the Bank of Canada now holding its policy rate steady, there's a growing expectation that the market might begin to thaw in the new year. As buyers get more clarity on where interest rates are headed, we could start to see a slow and steady return of activity, especially as we head into the spring market. Okay, let's pivot to our final major topic, the labor market. And this is where things get really interesting, because the job numbers tell a very different story from the GDP numbers. In November, the Canadian economy added a surprisingly strong 54,000 jobs. This was a solid 0.3% increase. Even better, the unemployment rate fell significantly, dropping 0.4 percentage points to 6.5%. This suggests the job market is much more resilient than the weak GDP report would have you believe. Digging into the details, most of these new jobs were full-time positions, which is a sign of stability. The gains were also led by the private sector, which is another positive indicator. One of the most important figures for the Bank of Canada is wage growth. Average hourly wages grew by 3.8% year-over-year in November. Now, that's still a healthy raise, but it's a noticeable slowdown from the 4+% growth we were seeing in previous months. This moderation is a good sign for inflation, as it eases what's known as wage push pressure, where rising wages can lead to companies raising prices. So, what does this all mean when you put it together? We have a situation where economic growth is stalling, but the job market is holding up surprisingly well. This creates a real puzzle for the Bank of Canada. They're trying to balance the risk of a recession caused by weak growth against the risk of inflation staying too high, which could be fueled by a tight labor market. This brings us to the Bank of Canada's final interest rate decision of 2025. As many expected, they decided to hold their policy rate steady at 2.25%. They've already cut rates by a total of 100 basis points, or 1 full percentage point, throughout 2025. And they said they now need time to see how those cuts are working their way through the economy. The bank's statement highlighted that, while headline inflation is near their target, they are still watching the risks closely. They specifically mentioned ongoing global trade uncertainties and geopolitical tensions as potential threats to the economic outlook. This decision to hold steady signals a wait-and-see approach. They're not ready to declare victory over inflation, but they're also very aware that the economy is fragile. So, to wrap it all up, Canada's economy is ending 2025 in a state of stagnation. GDP is weak, but the labor market is resilient. Inflation is near target, but high food prices are still a major pain point for households. The housing market is in a holding pattern, waiting for a signal on interest rates. The Bank of Canada is on the sidelines, carefully balancing these competing forces. As we look ahead to 2026, the key questions will be: can the economy avoid a recession? Will the labor market start to soften? And when will the Bank of Canada feel confident enough to start cutting interest rates again, providing some relief to borrowers? It's going to be a fascinating and crucial year for the Canadian economy. Thank you so much for watching. I hope this breakdown was helpful for you. If you found this video informative, please give it a thumbs up and consider subscribing to the channel for more economic updates. We'll be tracking all these trends closely in the new year. Thanks again, and see you in the next video.